Okay, everybody. Good morning. Today, what I want to do is I want to concentrate on new tax laws. So, the biggest thing that's going to be one of the biggest things that you want to look at is going to be the Schedule A. So, one of the things that's going away is there is now a $10,000 max. So, you're going to see where it says taxes you paid towards the top of the form, and it says on there, your state income taxes, your real estate taxes, your personal property taxes. Those are the areas where your state income and local taxes that have been taken out on your W-2 will be here on line 5. Line 6, of course, is your property taxes, and line 7 is the personal, which is what your DMV and your car registration fees go. So basically, those three items added together, if they add to more than $10,000, you're maxed out. So the maximum you can now take is $10,000, and that's it. Which is the big cry that's been going on in both New York, New Jersey, California, all the very high taxed individual states, because of course all those taxes you're currently paying are now no longer deductible. So the next thing you want to take a look at is going down the page where it says interest you paid. Number 13, which is mortgage insurance premiums. That basically is an item that's been going in and out. Now, what do I mean by that? Okay, so when they first passed the tax reform back in December of 17, they left it off. So anybody that had mortgage insurance premiums along with their mortgage, their mortgage payments, they were no longer able to deduct those. So that became non-deductible. However, back in February, the Democrats, because there was a budget fight, shoved it back in, so they had to sign it, and they shamed the Republicans for signing it. So it came back in February, which meant there were a whole bunch of amended returns that need to be prepared for all those clients that we didn't take advantage of that filed early. So whether this item remains again this year is going to be a question, because now, after the midterm elections are up, they're once again talking about another tax reform going in effect in December of this year, which will be another interesting fact, though. Of course, as we know, for tax planning purposes, it always makes it very difficult for all professionals and everybody in my field, and even in the mortgage fields, because back in the day, of course, whenever anybody got foreclosed on or had a short sale, you were then either going to be on the hook for the amount that was forgiven or you weren't. Well, the federal government back in the day passed a law that you wouldn't have to pay taxes on that. But now they've been whiffing back and forth since now all these short sales have gone goodbye. So a lot of these things are left up in the air until December, which gives us no time to really plan for the rest of the year. So that's kind of where we're at, and it's kind of where we all are at. Now, the other question is going to be, okay, so if we're getting rid of all these deductions, I said another thing you want to look at is the very bottom of the Schedule A. Down where it says job expenses and certain miscellaneous deductions, line 21 to 27, that entire section is now gone. So you can no longer take anything as far as unreimbursed employee expenses, union dues, any additional teaching expenses above the $250 threshold, which my teachers would understand. So your tax preparation fees, any legal costs that you paid in alimony to get extra alimony out of your ex, all those things are now gone. So you can't deduct any of those anymore. They were, of course, always subject to 2.5% of your adjusted gross anyway. So basically, if you look at it on a $100,000 salary, if you had $2,500 or less in those type of deductions, you weren't getting them anyway. So that's another thing to keep in mind. The medical expenses, not that I'm going to skip around, but the medical expenses are still at 7.5% right now. Which again, on my $100,000 example, is if you have medical expenses less than $7,500, you're not going to be able to deduct those anyway. So we're talking about people that really have a lot of medical expenses that are very sick that be able to start taking advantage of that. And that's usually when I tell my clients to start keeping track of all their receipts, because that's what you're going to need in case you get over the threshold. Now, the next question is going to be, okay, so we're getting rid of all of these deductions, which means our taxable income is actually going to increase. So one of the things they've done is they've also doubled the standard deduction. So those are those folks that, of course, don't have mortgages, don't have much of write-offs. So now they're subject to the standard deduction being doubled. So for that single taxpayers would be meaning that it's going to go up to about $12,000, which will increase about $6,000 in deductions. Married couples are going to get a $12,000 increase. Obviously, there's two people, so it's going from 12,000 to 24,000. So what they're saying though is they also massage the tax rate tables. You want to insert the 2017 tables and the 2018 tables here. So when they did that, what they've done is they claim that because they're taking away deductions, they're also reducing how much tax is going to be calculated on the remaining income.